$1 million is the goal. And when you first start investing, building a seven-figure portfolio seems impossible to achieve, and understandably so. But it's not as far out of reach as you might think. In fact, 1,700 people become millionaires in the United States every single day, and reaching this level can honestly be as simple as just investing in the right stocks, like the three that we're talking about in this video. If you would have just invested $10,000 into these three stocks and then forgot about it for a few decades, today you'd be sitting pretty in the seven-figure club. What's interesting about these two is that, ironically, the lowest yielding stock out of the bunch is the one that would be generating the most dividend income for you, like by far. And with this one, it also would have taken you the least amount of time to reach $1 million, which we'll see momentarily. But getting into the first stock, this one is Johnson & Johnson. And as you can see today, Johnson & Johnson has a current share price of $163.32. But if we were to go back all the way to 1979, if you were to have invested $10,000 into Johnson & Johnson, you would have been able to buy almost 141 shares, which will give Johnson & Johnson a split adjusted share price of $71.04. And what's crazy is that if you would have just let this $10,000 investment into J&J in 1979 just do its thing over the years, today you would have a current value of $1.1 million, guys. That's so crazy. You would have gone from $10,000 to $1.1 million. And when you take stock splits into account, I mean, originally you would have had about 141 shares, but today that would grow into about 6,700 shares. That's insane. And what's more is this doesn't even take into account dividends or dividends being reinvested. And when we take those into account, I bet this current value would be somewhere north of $2 million. I can't help but think it'd be considerably larger than this number right here. But anyway, in terms of the dividend income you'd be generating today from this one position, Johnson & Johnson currently pays $4.76 per share per year in dividends. And when you multiply that by the 6,700 or so shares that you'd have today, just this year you would be bringing in $32,162 in annual dividends, which is so insane. And with a $10,000 initial investment, it means you'd have a 320% yield on cost. And $32,000 in annual dividends after such a long period of time, 40 or 43 years, may not seem like a whole lot of money to be bringing in. But remember, all of this came from investing only $10,000 and then doing nothing for decades. That's what's surreal about it to me. And if you thought that was cool, just wait till you see how much you'd end up with investing in this second stock, which is Pepsi, who has a current share price of $185.40. And once again, if you were to go back decades, we're going to do 1980 in this situation. If you would have invested $10,000 into Pepsi in 1980, you would have been able to pick up 405.5 shares, which when adjusted for splits means you would have been able to buy it for $24.66 per share. And then once again, just based off this initial $10,000 investment, today you would be sitting on $1.3 million, and your initial 405 shares would have grown into about 7,300 shares when we adjust for splits. And then once again, this does not include dividends being reinvested, and I can't imagine what this number would look like if we were able to include dividends in this calculation. And then as far as the dividend income that you would be generating from Pepsi, today they pay out $5.06 per share per year, which when multiplied by your current 7,300 shares would leave you with an annual dividend income of just under $37,000. And with the $10,000 initial investment means you'd have a near 370% yield on cost. But then guys, this brings us to the third stock of the day. This one is Microsoft, who has a current share price just about $337. And Microsoft's been pumping so far this year. Look at this, guys. Just so far in 2023, they're up nearly 41%. That's very substantial. Now, Microsoft is the lowest yielding stock out of the bunch. And remember what I said at the beginning of the video, the lowest yielding stock is the one that would actually be generating the most dividend income for you today, and also would have taken the least amount of time to go from $10,000 to $1 million. Now, while Johnson & Johnson and Pepsi both would have taken about 43, 44 years to get you from 10K to $1 million, with Microsoft, you would have been able to get there in less than 30 years. So if you would have invested $10,000 into this company in 1994, you would have been able to buy about 199 shares, which when adjusted for splits would leave you with an average share price of $50.24. But in just 29 years, your initial $10,000 investment would have grown to just north of $1 million. You'd have $1.07 million in the bank. And with all of the different splits, your original 199 shares would now be about 3,200 shares. And as far as the dividends go, Microsoft currently pays $2.72 per share per year, which when multiplied by your near 3,200 shares would leave you with an annual dividend income of $8,662, which with a $10,000 initial investment means you'd have about an 86% yield on cost. Well, hold on a second, Ryan. What gives? You said that the lowest yielding stock was going to generate the most income. $8,600 is a lot less than what we saw with Johnson & Johnson and Pepsi, and you're totally right. But let's say that we go back in time a little bit farther, a little bit closer to when you would have invested in Johnson & Johnson and Pepsi, and not not even as far back. Let's say that we started investing in Microsoft in 1986 as opposed to 1994. This situation is going to look a lot different. So same thing, if you would have invested $10,000 in Microsoft, instead of 1994, we're looking at 1986, which is the farthest back this calculator will let us go. But in this situation, instead of being left with $1 million, your initial $10,000 would now be worth $30.6 million. And furthermore, you would have about 91,000 shares of Microsoft. So you would have 30x'd your money investing in 1986 compared to if you started investing just 8 years later in 1994. That's just completely blowing my mind. And as far as your dividend income goes, with near 91,000 shares, you would be bringing in $247,272 in annual dividends, which I don't even know what the yield on cost there would be, like a near 2,500% yield on cost. But either way, I would imagine in this situation, you would be one happy camper. I know I would be. And I don't know about you, but these numbers get me really excited, and being able to see what's possible being invested in the market over a long period of time is extremely motivating. More than anything though, I think this should serve as a reminder that getting these sort of returns isn't rocket science, and it really just comes down to a couple essential factors. The first of which is to base your strategy around investing in high quality, profitable companies that demonstrate consistent growth. The only type of company that can offer returns like these over a long period of time is one with strong fundamentals, a solid business model, and a track record of generating positive earnings. These are the type of companies you want to have in your portfolio, and if you just stick with them over a long period of time, it's kind of hard to lose. Which brings me to the second essential factor, which is that you absolutely, without exception, need to have a long-term mindset. One of the most common phrases that you'll have heard before is that time in the market beats timing the market, and I think what we saw earlier is definitely evidence of that. Really, the only way to capitalize on the power of compounding returns is to stay invested in the market over an extended period of time. But if you want to speed things up, and if you want to live off dividends sooner than later, then there is a potentially quicker way to get there. And in this next video right over here, I'm showing you what the fastest way is, and also share with you why the fastest way might not be the best way. So click right over here to check it out, and I'll see you in the next one.